Hello everyone, and welcome to another weekly update on my £100,000 investment portfolio. It's been another positive week in the markets, and our portfolio has benefited nicely. We'll dive into the specific numbers shortly, but first let's recap what we'll cover today. This week's update will focus on the dividends received from our various holdings, including Dowlis Group, Vici Properties, Coca-Cola, and more. We'll then discuss how these dividends are reinvested to purchase additional shares, further boosting our passive income stream. We'll also delve into the exciting new additions to our portfolio this week: Lloyds, iShares UK, High Dividend ETF, Vodafone, Main Street Capital, and Arbor Realty Trust. Finally, we'll touch upon the importance of REITs in a diversified portfolio and illustrate the power of compounding with a historical look at the S&P 500. It's been a good week for our portfolio with a gain of around £550. This brings our total return for the month to an impressive £4,500. These gains are largely attributed to the strong performance of the overall market. However, it's important to remember that investing is a long-term game, and short-term fluctuations are inevitable. While we're pleased with the recent gains, we remain focused on our long-term strategy of building a diversified portfolio of high-quality companies that pay consistent and growing dividends. One of the most satisfying aspects of investing in dividend-paying stocks is receiving those regular payments directly into your account. This week, we received dividends from several companies in our portfolio: Dowlis Group, a leading global manufacturer and supplier of specialist products and services for the infrastructure, transportation, and energy industries; Vici Properties, a real estate investment trust, or REIT, that owns one of the largest portfolios of gaming, hospitality, and entertainment destinations in the United States; Coca-Cola, one of the world's most recognizable beverage brands, with a long history of paying dividends; Nike, a global leader in the design, development, manufacturing, and worldwide marketing and sales of footwear, apparel, equipment, accessories, and services; Imperial Brands, a multinational tobacco company with a portfolio of some of the world's most popular cigarette brands; Renewables Infrastructure Group, a London-listed investment company that invests in renewable energy infrastructure projects in the UK and Europe; PepsiCo, a global food and beverage company with a portfolio of iconic brands, including Pepsi, Frito-Lay, Gatorade, Quaker, and Tropicana; and Gladstone Capital, a business development company that invests in debt and equity securities of lower middle-market companies in the United States; Broadcom, a global technology leader that designs, develops, and supplies a broad range of semiconductor and infrastructure software solutions. These dividends, while seemingly small individually, add up over time and play a crucial role in our reinvestment strategy. Reinvesting dividends is a powerful strategy for long-term wealth building. By automatically reinvesting our dividends back into the market, we purchase additional shares of our existing holdings. This in turn generates even more dividends in the future, creating a snowball effect that can compound our returns over time. For example, let's say you own 100 shares of a company that pays a £1 annual dividend. This year, you receive £100 in dividends. If you reinvest those dividends back into the company, you'll purchase additional shares. These new shares will then generate their own dividends in the future, increasing your passive income stream. Section 5. New additions to the portfolio, targeting value and yield. This week, we added 5 new companies to our portfolio, each selected for its potential for long-term growth and attractive dividend yields. First, we have Lloyds, a British financial institution offering a wide range of banking and financial services. Next, the iShares UK High Dividend ETF, an exchange-traded fund that tracks the performance of UK companies with high dividend yields. Then there's Vodafone, a British multinational telecommunications company with operations in over 20 countries. We also added Main Street Capital, a principal investment firm that provides long-term debt and equity capital to lower middle-market companies. Lastly, Arbor Realty Trust, a real estate investment trust that specializes in providing financing for multifamily and commercial real estate properties. We believe these new additions will further diversify our portfolio and enhance our overall returns over the long term. Section 6. REITs and their role in a portfolio. REITs, or real estate investment trusts, are companies that own, operate, or finance income-generating real estate. They offer investors a unique way to diversify their portfolios and gain exposure to the real estate market without directly owning physical property. REITs are required by law to distribute at least 90% of their taxable income to shareholders in the form of dividends, making them particularly attractive to income-oriented investors. They provide a steady stream of passive income and the potential for long-term capital appreciation. In our portfolio, Vici Properties and Arbor Realty Trust are examples of REITs. These companies allow us to participate in the potential growth of the real estate sector while enjoying consistent dividend income. Section 7. The Magic of Compounding, a historical look at the S&P 500. Compounding is often referred to as the eighth wonder of the world, and for good reason. It's the process of generating earnings on your initial investment as well as on any accumulated interest, dividends, or capital gains. To illustrate the power of compounding, let's consider the historical performance of the S&P 500, an index that tracks the stock performance of 500 large companies listed on stock exchanges in the United States. Over the past 50 years, the S&P 500 has delivered an average annual return of around 10%. This means that if you had invested £10,000 in the S&P 500 in 1973, your investment would be worth over £1 million today. This incredible growth is a testament to the power of compounding. By consistently reinvesting your earnings, you allow your money to work for you, generating even greater returns over time. Section 8. Join the journey, learn, invest, and grow your wealth. Thank you for joining me on this investment journey. Remember, investing is a marathon, not a sprint. By staying disciplined, diversifying your portfolio, and harnessing the power of compounding, you can build a brighter financial future for yourself. I am not a financial advisor, and this is not financial advice. These are just my personal opinions and experiences. Please do your own research and consult with a qualified professional before making any investment decisions.